And also AI has taken a lot of the enthusiasm. So it used to be that Bitcoin was the fastest horse, or for speculators, an altcoin, of that particular cycle was the fastest horse. And that's where kind of like, risky fast money would want to go. And now they see GPU stocks or RAM stocks, or private equity AI companies just soaring. And there's just more kind of enticement to put capital there. Another point is that, so partially because of the growth in AI, we've seen a pretty dramatic sell-off in software stocks. So software as a service stocks. I think the index for them is something like 30% since October, which is roughly, very correlated with Bitcoin's fall. And when you look at, say, either a 5-year chart of Bitcoin versus, say, the software ETF IGV, or even if you just look at like a 1-year chart, they're extremely correlated.
Over the past decade, Bitcoin has been the undisputed magnet for speculative capital. Whenever global liquidity expanded and investors began searching for the fastest possible returns, money almost inevitably found its way into crypto. Sometimes it went into Bitcoin itself. Other times it flowed into altcoins, DeFi, NFTs, or whatever new narrative was dominating that particular cycle. But this cycle, something different happened. According to respected macro strategist Lyn Alden, Bitcoin is no longer the only fast horse attracting speculative capital. A completely different technology boom has emerged, and it is pulling massive amounts of money away from crypto markets. Artificial intelligence. Over the last 2 years, AI has become the dominant narrative across global markets. Investors chasing explosive returns are now pouring capital into GPU manufacturers, memory chip companies, and private AI startups. These sectors have captured the kind of enthusiasm that once fueled major crypto bull runs. At the same time, Bitcoin quietly started behaving like something else entirely, a high-growth technology stock. In fact, when you compare Bitcoin's chart to major software indexes, the correlation is surprisingly strong. As software companies sold off sharply in recent months, Bitcoin followed an almost identical trajectory. Why is this happening? And more importantly, what would it take for Bitcoin to finally break out of this pattern? In today's video, Lyn Alden explains why speculative capital may be drifting away from crypto, how AI hype is reshaping financial markets, and what needs to happen for Bitcoin to stop trading like a software stock and begin to gain momentum. If you enjoy deep macro analysis like this, make sure to like the video, subscribe to the channel, and turn on notifications so you never miss our future breakdowns. Thanks for the support, and enjoy the video. Now, let's listen to Lyn Alden.
I think the biggest issue is there hasn't been a lot of top-line demand this cycle. And that includes like on-chain, buy a hardware wallet, stack Bitcoin type of demand. So completely non-paper demand. If that had come in, the price would be higher. So I think the fact that that was on the weaker side this cycle, left most of the demand in the corporate sphere, right? So most people buying either the ETFs in their brokerage account or buying the Treasury companies in their brokerage account, or in some cases institutions, buying their other products. And that's been by far the majority of the demand for Bitcoin this cycle. And so that lack of kind of like broad retail demand, I think is the single biggest factor. And then we can add other things on top of that. There's a little bit of fear about quantum, which I think is overblown, but it is I think affecting price to some degree. Just the overall kind of paperization of Bitcoin is an inevitable thing that it has to go through. So I think there are multiple factors, but I actually think the number one thing is just kind of lack of top line demand, either in paper or direct form.
So shouldn't the price actually increase more than when retail jumps in?
If there was more buying, if there was a tremendous amount of institutional buying, then yes, we would see a lot of increase. Now we have seen a decent amount of buying, but it's been offset by a similar amount of selling from longer term holders. And that so far happens every cycle. So every kind of major bull market, you see the percentage of coins that have been held for say 1 year or more go down. You see some kind of profit taking. And the general trend there is not that those people have, say, lost interest in Bitcoin, is that they've been holding for many years, and they might have put, say, 5% of their net worth in Bitcoin, and it's up over 10x, in some cases many times more than that, depending on how long ago they bought. It could be over 90% of their net worth at some point. Many of them, they want to upgrade their consumption levels. Maybe they started a family, maybe they just, they want to consume more. And so you generally see selling from some of those older holders and new buyers come in. Either directly or through these proxies, these treasury companies, these ETFs, and things like that. And while we did hit new all-time highs this cycle, and I think we'll have higher lows wherever we hit as well. So there has been more demand than selling, but there's not been a tremendous amount of new demand compared to selling, which is why we only kind of we hit moderate new highs. Nothing particularly tremendous, not even a double compared to the prior high for the cycle. And so it's not that there's no top line demand, and it's not that the institutions don't move it. I mean, they have a tremendous amount of capital that they can move it with, but it's been kind of mediocre this cycle, and it's been offset by the holders selling. I think quantitatively, the 4-year cycle is no longer relevant in the causal sense. Meaning that the amount of new supply that is affected by the halving, for example, that's kind of the key catalyst for the historical 4-year cycle. That used to matter in the first 3 or so cycles. That was a tremendous difference in the number of new coins hitting the market. Now that most of the coins have been mined, the annual kind of supply inflation rate for Bitcoin is well under 1%. It's a much bigger factor, the percentage of older coins being sold, than the halving. So I think that from a fundamental standpoint, the halving in the 4-year cycle is no longer relevant. But I do think that there's still a self-fulfilling prophecy around it, which is to say that many people still believe they're conditioned to the 4-year cycle. So I do think that there was some reflexive selling in Q4 of last year, because people had the view that, well, I mean, if it was going to hit its peak, it's going to do it this quarter, and might as well get out and buy lower. So I do think that there's still some remnant of the cycle, even though there's no fundamental reason to expect it to behave like that. There's many other variables that can move it around going forward, is how I view it. And I think liquidity plays a big role. I think bubbles popping plays a big role. So, for example, in the summer of 2025, some of those MNAVs on treasury companies just got really out of hand. I mean, strategy, less extreme because it's bigger, but I mean, it was over 3 times MNAV at its peak. Metaplanet, got over as late as June of 2025 was at like 8 times MNAV. In some of their earlier parts, they were higher, but even when they were pretty big, they got up to an 8 times MNAV at one point. Many of the others were just euphoric. And I expected that to come down, but it came down actually faster than I would have guessed. I mean, I would not have guessed we'd go from, say, 8 times MNAV on Metaplanet to 1 in a handful of months, but we did. Markets tend to move quickly when they move. So I think that we've kind of had to burn off that bubble. I don't expect us to have as big of a drawdown as last time. I think that some of the drawdown will be in those treasury companies. It already has been. I mean, some of them are literally down 99%. Other ones are down, kind of what you normally see in a Bitcoin bear market, because I think that's where the euphoria was. I think there was not a lot of euphoria in, baseline unlevered Bitcoin. And so I think that while it's obviously been a pretty severe market downturn, like something like 50% at this point, a little over at kind of the intraday lows, I think that we're not going to see one of those 85 or 90% drawdowns is my base case. I think we're closer to the bottom than the top. I think most of the pain's behind us. Not to say that the bottom is certainly in, but I think the worst part of the sell-off is behind us. We probably have a grind to go through until we're kind of back in a true bull market. And I think that, the most of the pain was in the levered entities.
One of the most important points Alden highlights here is that many investors have quietly noticed throughout this cycle, the type of demand driving Bitcoin's price has changed. In previous bull markets, Bitcoin rallies were fueled heavily by retail investors, ordinary people buying Bitcoin directly, moving coins into personal wallets, and holding them for the long term. That kind of demand created powerful momentum because it represented new capital entering the system at a grassroots level. But according to Alden, that dynamic has been noticeably weaker this time around. Instead of broad retail adoption driving the market higher, much of the buying pressure has come through financial intermediaries, particularly institutional products like spot ETFs and publicly traded treasury companies accumulating Bitcoin on their balance sheets. While these institutions control enormous pools of capital, their activity has largely been offset by another powerful force: long-term Bitcoin holders taking profits. When that selling pressure meets moderate institutional demand rather than explosive new retail inflows, the result is exactly what we've seen this cycle. New highs, but not the kind of dramatic price expansion many investors expected. Alden also challenges another deeply ingrained belief within the crypto community, the famous 4-year cycle driven by Bitcoin's halving events. For years, the halving was seen as the primary catalyst behind Bitcoin bull markets. The reduction in new supply entering the market created powerful supply shocks that pushed prices dramatically higher. But today, the situation is very different. Most Bitcoin has already been mined, and the annual supply growth rate has dropped below 1%. At this point, the percentage of existing holders choosing to sell has a far greater impact on price than the number of newly mined coins entering circulation. In other words, the halving may no longer be the dominant force behind Bitcoin's price cycles. Going forward, Alden expects a grinding consolidation phase for Bitcoin, the type of slow rebuilding period that often occurs before the next major expansion cycle begins. Let's get back to Alden's interview.
Why did Bitcoin see such a big correction?
I think a handful of reasons. One is I think that there was self-fulfilling prophecy from the 4-year cycle. Just people thought, okay, if it didn't, whatever peak it got here is probably the peak for a while, so they sell prematurely. Another one is, so I'm generally a bear on the broader crypto space. So outside of Bitcoin and stablecoins, I think the value there is pretty small. And they kind of exhausted their narratives. They kind of went through, alternatives to Bitcoin in an early cycle. Then it was ICOs, and then it was DeFi and NFTs. Lately, this cycle was kind of like meme coins, and they kind of exhausted their narrative. And also, AI has taken a lot of the enthusiasm. So it used to be that Bitcoin was the fastest horse, or for speculators, an altcoin, of that particular cycle was the fastest horse. And that's where kind of like, risky, fast money would want to go. And now they see GPU stocks or RAM stocks, or private equity AI companies just soaring. And there's just more kind of enticement to put capital there. So I think from a Bitcoin perspective, there's an overhang from the kind of the broader crypto space. And then even within Bitcoin, there's this fast money saying, well, I can just go into AI if I want something really quick. And then another point is that so partially because of the growth in AI, we've seen a pretty dramatic sell-off in software stocks. So software as a service stocks. I think the index for them is something like 30% since October, which is roughly very correlated with Bitcoin's fall. And when you look at, say, either a 5-year chart of Bitcoin versus, say, the software ETF IGV, or even if you just look at like a 1-year chart, they're extremely correlated. So I think that algorithms and other trading kind of methods have lumped them together. So basically, as we see kind of the rise of AI, the disruption of the SaaS kind of per seat pricing model, the sell-off in some of these companies, I think Bitcoin is kind of sympathetically trading with those. Like it's been lumped in as a selling pressure. I think some of those are becoming quite cheap, and I think obviously Bitcoin's oversold here. It's got one of the lowest weekly RSIs in its history. And so I think that it's kind of been caught up in that trade rather than some of the more positive parts of the market. But I think I think there's opportunity both in certain software stocks as well as in Bitcoin at these kind of depressed levels while almost everything else has gone up.
What could be that change of narrative that makes it decouple from software companies, or that it eventually starts to go up instead of continues to fall?
Well, I think just fundamentally a different asset. So sometimes correlations can break with no particular catalyst. They just stop behaving the same way. Two is that they might continue to be correlated, but software stocks eventually bottom. I mean, I think part of the problem with software stocks is that many of them are trading at very high valuations. So a lot of the sell-off is justified. They were perceived as kind of like no risk, strong balance sheet. They always grow. You can pay 50 times earnings for them, or in many cases unprofitable. So just basing it on revenue, even though they're publicly traded and around for 10 plus years. There's been I think a pretty rational correction in those, but eventually they get so cheap that it gets like the risk I think is overblown for at least some of them. So I think eventually software indices find a bottom, probably around the same time Bitcoin finds a bottom. So they could just their next cycle could still be correlated, and it wouldn't really affect my outlook. Yeah, I think that's kind of the main factor. I mean, like correlations can just literally just kind of break down for no particular reason. I think the narrative for Bitcoin at this point is it is the leading protocol for value. It's the leading decentralized ledger out there. it's worth, I mean, even at its peak, it was like 0.2% of global assets. So the bull case is basically saying that something like that, which kind of uniquely allows for liquid, portable, self-custodial capital, as well as the ability to make permissionless payments, that is worth more than 0.2% of global assets. So someone has a view that it's worth 2% of global assets, that's a 10x roughly, in addition to whatever global assets do as a group. And so I think that narrative is still intact. Now, people can point out that, in a world of increasing AI agents, they're going to want permissionless money to do things on behalf of those who run them. And some people have said Bitcoin is one that they're going to turn to, and I think there's some truth to that, but I think they're also going to turn to stablecoins because many AI agents are doing things with a fairly short-term perspective. They're doing things on behalf of their creators, their owners, and they want working capital that's pretty stable. But I think between Bitcoin and stablecoin, we're going to see more payments become digitized, and that in that more permissionless realm, which will then invite all sorts of government regulations, anti-privacy, procedures. So I think that's going to be a messy thing for a long time, but I do think that's one of the catalysts.
The explanation Alden provides here is both simple and surprisingly overlooked. For most of Bitcoin's history, the broader crypto market has constantly generated new narratives to attract speculative capital. First, there were alternative cryptocurrencies attempting to compete with Bitcoin. Then came the ICO boom, followed by DeFi, NFTs, and eventually the explosion of meme coins. Each wave created excitement, new participants, and fresh money entering the ecosystem. But according to Alden, that narrative engine may now be running out of fuel. Many of those speculative stories have already played out, and investors searching for the next technological revolution have shifted their attention elsewhere, toward artificial intelligence. In many ways, AI has become the new destination for the type of high-risk, high-reward capital that once flowed heavily into crypto markets. GPU manufacturers, AI software companies, and private startups developing new machine learning infrastructure are now attracting enormous investor enthusiasm. And that shift has had an unexpected side effect, because many trading algorithms and institutional models categorize Bitcoin alongside high-growth technology assets. The cryptocurrency has increasingly begun moving in tandem with software stocks. When software companies sold off sharply over the past year, particularly software-as-a-service firms trading at extremely high valuations, Bitcoin followed the same downward trajectory. But as Alden explains, correlations like this rarely last forever. Sometimes they simply break without warning. Other times, both assets reach a bottom around the same time and begin rising together again as new liquidity enters the system. And despite the recent downturn, Alden believes Bitcoin's core investment thesis remains unchanged. At its peak valuation, Bitcoin represented only a tiny fraction of global wealth, roughly 0.2% of all global assets. Even modest adoption as a decentralized store of value could push that share dramatically higher over time. At the same time, the rise of artificial intelligence could ironically strengthen Bitcoin's long-term use case. Autonomous AI agents operating across the internet may eventually require permissionless digital money to transact on behalf of their owners. That role could be filled by a combination of Bitcoin and stablecoins, creating an entirely new layer of digital financial infrastructure. But as Alden notes, that transformation will not happen overnight. It will involve technological change, regulatory battles, and the gradual evolution of how value moves across the internet. For now, the key takeaway is that Bitcoin may simply be caught in a larger macro transition, one where speculative capital is temporarily chasing the next big technological breakthrough. The real question investors should be asking is not whether Bitcoin is finished, it's whether the market is underestimating what happens when liquidity returns and capital begins searching for the next asymmetric opportunity. Thanks for watching. If you enjoyed this breakdown, let us know your thoughts in the comments below. Do you agree with Lyn Alden's view that Bitcoin is currently being lumped together with software stocks? Or do you believe a major decoupling is coming sooner than most investors expect? Make sure to like this video, subscribe to the channel, and turn on notifications so you don't miss our next deep dive into the global economy and the future of Bitcoin. Thanks for watching.